Welcome to the daily update where I'll go over the action in the market for Monday, January 27th, and we'll see how things look for Tuesday, January 28th. Pretty interesting day. Yeah. Developments over the weekend. We now have the word DeepSeek as part of our vocabulary. There's tariff things that are going on, not only in Colombia, but concerns about other things that are happening in Japan because the Bank of Japan raised interest rates. A lot of that kind of came together. It really manifested more in the tech sector and semiconductors. They got hit pretty hard. But when you look at everything together, it was a pretty positive day. Now, Nvidia was down 17%, and that's not positive. It goes from being in a solid uptrend to a bear market in one day. But the rest of the market is holding up pretty well right now. We're still positive. The 20 and 50 period moving averages are holding up, but we're having to deal with new realities. One thing I was thinking about is I heard this referred to a couple of times is this DeepSeek is like Sputnik was back in the late 1950s when Russia sent up a satellite. We didn't know anything about it. We heard about it. This thing was flying overhead, freaked everybody out. It got called a mania, and that got us to the moon. So let's see. This could end up being longer term positive from the US perspective because nothing really rivals the American spirit more than getting caught off guard with something and then being challenged with something and saying, okay, now we're going to outdo and we're going to be the leader in this. That's what has really led to some great things happening in the past, and we'll see how it works out this time. So, all right, let's go back and talk about what happened and then look at some charts. We had a massive gap lower open. I was watching things as the futures were just tanking during the night. We got down to about being down 3%, and then we bottomed out and started to come up. We tried to get back up to the 6,000 level with the futures and just weren't quite able to do that. Of course, that produced a massive gap lower at the open. We opened below S4, so I had to crank out the old pivot point calculator, which was at 59.88. So we dropped below the 6,000 level, and then prices climbed back above S4, but we hit resistance at 6,000, and then we fell back to S4 again. And then really that was about it. We spent the day chopping between S4 to the downside and about the 6,012 level to the upside, and we closed at the intraday high. Now, you take out the gap, and it wasn't all that negative of a day. Unfortunately, gaps count, and that goes into the calculation for how the index works. We ended up being down 1.46% on above average volume. This freaked out a lot of people, and it's probably a good thing. I was pointing out on the website and in the program that this is a little bit reminiscent of what happened last summer. We're still dealing with that situation. That has to do with Japan and rising interest rates over there, but it's pop news. Everybody's talking about it. Twitter, X, it's all over the place there. And this is what typically happens. People learn about something they never heard about before, they freak out about it, and then it gets replaced by something else over the next couple of days. Well, our job here is to keep an eye on these things that aren't necessarily pop news and look at the trends. Don't freak out. After last Friday, we were still positive. After Monday, we continue to be positive. We'll see. Now, the situation may change, but all we can go with right now is what we're seeing with the data that we have. And the fixation in Monday's session, of course, was all about AI and what's that going to do to semiconductors and all the utilities and things like that that are dependent upon this whole AI craze. And interest rates actually went down, and that could be helping stocks too. That probably helps stocks hold up a bit better. We're getting close to that 4.5% with the 10-year yield. And if we drop below that, that could be positive. We're going to get a lot of inflation data this week. We have the first reading for the fourth quarter of GDP for 2024. That has an inflation component. We're going to get the jobless claims like we always do. We're going to get core PCE in Friday's session. So that's coming out. And then we have the Fed meeting on Wednesday. Now, they're not going to change rates, but they're sure going to say some things, and we'll see how the market reacts to that. And then the geopolitical things that are going on, those really are kind of, they're there and they're real and they impact things, but they're, from a news perspective, kind of taking a back seat right now, as you have the new administration just doing all these changes really quickly, and companies are having a hard time keeping up. Of course, you have, the folks that don't agree with anything that's going on. But then you have a lot of folks that are like, hey, this is kind of cool. We like this idea. We're kind of turning back into what America used to be like, and we like that. Where other folks are like, no, 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 this is all bad. We're going in the wrong direction. And that's part of the debate that goes back and forth. Okay, some comments. Stocks ended up closing mixed. We were actually up in different areas of the market. The Dow was up. But what got hammered were the big tech stocks, semiconductor related names, utilities, because they need electricity for all this stuff. Even nuclear power plants got hit. I guess no pun intended there. Um, in Monday's session, because big companies like Microsoft, Google, they're looking to buy nuclear power plants to generate the electricity that is needed for all this AI development that's going on. And, that's kind of like, ooh, how can they do that? What about all this green stuff, and the Green New Deal and everything? Well, these guys need power. And so they're trying to figure out a way to do this. And that kind of brings up the whole nuclear power debate again. But the companies that are involved in AI, last week they were the darlings. This week they just got hammered, at least in Monday's session. We'll see if they can bounce back from here. But we didn't see money coming out of the market necessarily. We saw it rotating from growth over to other areas. So yeah, our growth to value ratios are taking a hit. They're not turning negative, but they declined on Monday. But money's going into different parts of the market, not just going out into money market funds. Okay, then China's DeepSeek AI model, it got a lot of attention. Now, if you really pay attention to this stuff, you had heard about this before. And there's a lot of potential propaganda that's happening with this, because they've come out and said, it's been reported anyway. I read through a Reuters article and a Bloomberg article that it's supposed to be more cost effective than what's being developed in the US, specifically with Chat GPT. But the big thing is this true? Can it really deliver on the promises that they say here now? Just like with Sputnik, it's like, oh my gosh, the Soviets are ahead. We've got to start learning the Russian language. We need to improve in math and science, and we have to get ahead from a technological perspective. And with the American spirit the way it is, that's a challenge. And we'll see if America's up to that challenge. Or is this going to be just some pop thing that gets dealt with for a few days and then just kind of gets forgotten about? That's kind of where we're at least from the perspective that I see. And semiconductors, yeah, they got hit. They were down 9.2%. Nvidia was down 17%. But the broad market held up and actually saw advances. And you look at some of our charts, they improved in Monday's session. The 20 period and 50 period simple moving averages for the S&P, they provided support. We're still above those levels right now, but small caps are still below their 50 period simple moving averages, but they're not necessarily falling apart, even though they were down. We were able to get back above the 50 period simple moving average with the bank ETF. I've been keeping an eye on the financial sector. Whenever interest rates really start to go back up, because that can really pressure banks and especially smaller banks. and I really focus more on the whole financial sector, which has been doing good, and they had great earnings reports. But the bank ETF was lagging, and that's why I was kind of honing in on that one. Well, we were able to get above the 50-day moving average on Monday. Can we stay above it? And our list is quite a bit shorter now. The charts that we use that show the trend, those are off right now because they had been extreme positive with the down day. They've switched over to more neutral right now. We still have the stochastics, the McClellan oscillator, still looking really good there for the S&P. And we went up as far as our 20 period moving average study. So, yeah, looking pretty good here. And I'll show you the charts for all these things. And we went up. We're getting an even higher reading now with the advanced decline study that we do, and then take a 10 period moving average of that. It went up. Then the PMO studies are still looking pretty solid there. We'll see if the change comes to the scenario here after the Fed meets. That's kind of off a little bit to the side right now because we have to wait for Wednesday for all of that to come out, and then the inflation data that's going to be released to see if there's any change to this scenario. The dollar was down and interest rates were down. After Friday, we were at 4.63% with the 10-year yield. We closed Monday at 4.53%. We're getting close to that 4.5% level with the 10-year. Sentiment, yeah, people were freaking out. We were neutral, just a tick under 50 after Friday. We're back down to negative at 39. And we're back to looking negative with our ADX. So we're getting a bit of a mixed picture right now. The red line came back above the green line where it had been looking positive. We're still not trending as the ADX is getting rattled around right now. And it's also below 20 and it's below its moving average. And of course, with the down day, we have to go with negative as far as the bias. And I'm changing our momentum to mixed right now. That could actually be mixed to positive because other areas of the market held up well and actually saw some advances. All right, so we just had new home sales. Seems like what? There was an economic report on Monday. It came in stronger than expected at 698,000. They expected 680,000 and up from the 674,000 from the previous report. And here's a chart. This is a year over year basis here, showing it going back up. Now, interest rates are going up and home prices are going up, but we're still seeing new home sales increasing as well. And then the median home prices, the 3 month average, yeah, they're going back up here. And with interest rates going up, that's going to make it more difficult for this kind of a trend that we saw in this report to continue. And then a higher first 5 days in 2025 is a good sign. That's one of the benchmarks that is used. What we've been using the last couple of years, because there's a Santa Claus rally, there's the first 5 days, and then we look at the whole month of January. And if that ends up closing positive, we still have the rest of this week to go with that, then that tends to bode well for the overall market. Yeah, there's lots of stuff out there, and I'm going to show you some stuff here. Yeah, there's concerns, but that's what we want. We want the market to climb a wall of worry. There's this attempt to make a lot of comparisons between what's happening now and what we saw in 1928 into 1929. Okay, yeah, we'll just be aware of that, follow it, and then take our analysis approach day after day after day, and then just see how things play out. All right, mega cap growth and tech positioning probably come down a little bit here after Monday. It's still pretty high overall when we had this chart. Now, all these charts came out before Monday's session. And then the commodity trading advisor exposure to equities, right, coming in at about 50% right now, still showing that stocks are more favorable. And we've been looking at a lot of valuations here. This obviously dropped after Monday with the NASDAQ 100. It got hit pretty hard because that's where a lot of these mega caps and semiconductor stocks reside. Coming in at 29 with the latest reading, 25 here with the small caps. Now, the other metric that I look at over the weekend has this close to like 15 here, where the S&P 500 is at 22. That's about what we've been coming up with. The equal weight version of the S&P is under that 20 level, and mid caps are I what I look at has both of these small caps and mid caps at about the same valuation point, especially when you're looking out forward. Okay, then what's holding them back? This is just comparing the lag of European darling stocks to US stocks. The S&P 500 with the stocks Europe 600. That's kind of their equivalent of the S&P 500. And I went over this in the weekend video, but this was on Isabel Net. There's just about a 98% chance the Fed is going to leave rates unchanged. They've said that's what they're going to do. There's still some holdouts over here thinking, well, maybe, just maybe. But yeah, it's not what they're going to do on Wednesday that the market's paying attention to. It's what are they going to say and what's the context of what they say, specifically Jerome Powell. All right, found some interesting charts here. When you look at AI, what do small business owners think as far as how is this going to benefit them? And a lot of people, and this is what I've been hearing about too, just do things faster. You can save time. That's one of the benefits of AI is you can do some of the same mundane tasks, but you get a computer to do it that's supercharged with AI and it can do it very quickly. Also, the idea of saving money, require employee upskilling, so you have better qualified and trained employees, grow sales, eliminate jobs, reduce labor costs. That's kind of causing some concerns out there because anytime we have some kind of a technological breakthrough, I mean, there's one part of the economy that kind of gets left out as we go into a new part of the economy. And that's what we're trying to deal with right now. What jobs are going to be eliminated? What's that going to do to a lot of these like manufacturing jobs and computer programming jobs? If you can have AI do the programming for you, why do you need a whole fleet of programmers? That kind of thing. And disrupt our entire industry. Yeah, I mean, this is a newer technology that we don't really understand what it's capable of at this point. There's a lot of speculation out there. There's books that you can read. There's even novels written about this that you might find interesting and disrupt our value proposition relative to our competitors. Yeah, the back in the early 70s there was a book called Future Shock, and it basically said that technology will get to the point where the stress is keeping up with technology. It's changing so fast that by the time you learn what's available now, we're already on to the next thing. And that could happen in some of these businesses. It's always, no matter where we're at, we're always behind the curve with what's available out there. Okay, and then this was put up by Chris Schiavocco, and just showing how things are holding up for right now. Yeah, we were down, and it was not a very pretty day. This is the Nasdaq right here. It's still above all these anchored moving averages, and the moving averages are still going up. So, yeah, it was not a good day at all. And if you got caught, in some areas that you probably took a hit and you didn't really like the day, but if you look at the bigger picture, it's still holding up for right now. We'll just evaluate this every day and see how things unfold. This is kind of interesting too. I periodically I'll dive in and I'll start looking at cycles. I've tried it with different days and there's different outfits out there, and I seem to find some cycles that work, and then I try them in real time and they fall apart. So, but this is kind of predicting. This is around the semiconductors where there's a cycle that we're going up right now, and thinking that we're going to top out right around February 7th and then decline from here. Who knows? Um, I'll pay attention to this. I'm constantly doing more research in these areas just to see if it can give us some insight. I don't use these things to make decisions, kind of like with seasonality. We just use this as a guide to be aware of here. Okay, and then this is from seasonality from Stock Traders Almanac. This is taking each year of the 4-year presidential cycle and showing, okay, where are the weak spots, where's the sweet spot. It really ends up coming in about the third year of a presidential cycle where you tend to be a little bit weaker in the first quarter. This is where we're at right now, and tries to put some seasonality perspective into this. And this is kind of interesting too. Now, you notice in a lot of the analysis that I do, I talk about volume. And that's an important part of technical analysis and looking at charts. When you see an increase in volume when we're going up, that's positive. If you see an increase in volume when we're going down, that can be negative. But when volume gets really high, one way or the other, whether we're going up or down, that can often mean some kind of a climax. And so I have a lot of indicators, like our smart money indicators, that use volume. But what we're seeing in some of the research is that a lot of the volume is taking place that's not even on the exchange. It's not even getting calculated into the charts that we're looking at. So you have on exchange, off exchange, and it's actually getting higher off of the exchange now at 50%. Okay, and trying to advance this here. This is kind of interesting too. The 10 largest equity ETF flows. This is the 3 month total. That's positive, but when you're getting a really high reading like this, you have to ask yourself who's left to buy. So this could actually end up being somewhat negative because it's like everybody that's in the market is in the market. And then this is another thing that could potentially be a little bit of problem for the market. And this is the total US speculative option volume, calls to puts. It's getting very high. Folks are very, very optimistic. And we're seeing this in the skew index that we're looking at right now, which is still giving us a very high reading. But when you have everybody thinking one way, the opposite tends to happen. And so with this really high reading right here, it's, you know, we've had really high readings like this before, and it doesn't necessarily mean that things are going to turn right away, but it could suggest some problems down the road. Okay, here's the intraday chart. A lot of the action just came boom right at the open, and then we just stayed above S4 down here. We tried to get back up. We got up around to the 6,012 level or so, and that was about as high as we were able to get back up. But we didn't see a lot of intraday selling take place. It pretty much all came from the gap that we saw. And this just shows that too, that we were kind of light and fluffy here when the futures started trading. And then boom, everything just changed, everything hit. We were down about 3% at this point. And then, but you can see we started to come back before the market even opened. And this is actually kind of positive looking here, how we moved up off of these lows because markets tend to overreact. And we're seeing a little bit of a shift here where the blue line's coming down as the red line's going up. This is more of a shift over to quality. When weird things like this happen, you'll see the red line going up and the blue line going down. Is that going to change the overall climate? They're pretty much even with each other right now. So we'll just keep watching this. And we took a hit with the growth to value ratio. It had been looking good since the end of November. We had been going sideways, not looking all that good now. Are we going to be able to bounce back up from this, or are we going to see a continuation of the decline and see if the overall climate is changing and the market's starting to turn more defensive? All right, end of day, look at how much growth was down 3.67%, where value was up. And with the mid caps, it was down over 2% with growth, where value was up, and was down 0.83% with small cap growth, where value was up. So a real mixed session from that standpoint. And so we're taking a bit of a hit with our small cap growth to value ratio on the end of day charts. Mid caps also showing a hit here, taking a hit here with the S&P growth to value ratio. What we're waiting to see now is this something that's more short term that's going to work itself out? Or are we seeing that general shift over to a different type of market environment? We can't answer that right now. You can come up with all kinds of conclusions and you can say, I think this, I think that. We have to watch this played out. We're still looking positive here, even though we're taking a bit of a hit in the short term. And took another hit here with our growth versus value ETF coming further down into the rainbow. And this had really been a little bit weaker already. This is kind of giving us some warning signs where our other charts were actually holding up better. Discretionary took a hit compared to staples. When you have events like happened in Monday's session, staples really went up and discretionary went up too, but because it was more defensive, staples ended up really climbing, and that's what sent the ratio down. But overall, discretionary is still outperforming staples. We did take a hit here, almost down 3% with large cap growth. We're underneath the 50 period moving average now. So to turn back more positive, we're going to have to recapture that. As far as the trend, we were positive, but then we crossed over red now. We're still below 20 with the ADX and we're below the moving average. So we're in a non-trending negative environment now. Same thing with the short term. Switched back over to negative after being positive. Volume really picked up. A lot of people freaking out that way. And then this is a weekly chart that we look at, which is a composite of different sentiment gauges. Still coming in at 76.63. That's a real high reading, but this is quite a bit different than what I look at every day. I use the CNN Money Fear and Greed Index. This could also be negative for the market as well. These are insider transactions. We're getting a very high reading here. And I showed a chart over the weekend. I may even have it here. I don't remember. Um, but a lot of corporate insiders are selling right now. These are legal insiders like CEOs and corporate officers, and not the illegal kind. If you saw the first Wall Street movie with Charlie Sheen. And so we're seeing a bit of a pickup here with the insider buying ETF, but we fell back down here. This is kind of going in the opposite direction of what we're seeing happening. All right, the ulcer index still just a little bit above its moving average. Now, fear had been really coming out of the market, and it's pretty much at the average level right now, according to this. And we did go up with the VIX, but we started out over 20. By the time we opened, we were at 21 with the VIX, right around in that range. And so the VIX ended up spending a lot of the day coming down as well, which is positive. And the VIX of the VIX also spiked up. Not a real surprise there with the down day. We're turning up with the MACD, but the momentum is still down for the VIX, which is positive for stocks. Coming down a little bit, but still getting a really high reading with the skew index, which is suggesting there's a lot of calls out there that will benefit if the market goes up. And we declined with this fear gauge, where we actually went up with this other fear gauge. So getting some mixed signals here. And we saw a real fall off of the risk on versus risk off ratio. Not a surprise there. When stocks like Nvidia do well, this ratio goes up. When they get hit 17% in one day, this ratio really goes down. And we're going up with the daily chart of the equity put call ratio. And then over the weekend, I thought, man, this is an erroneous chart, but we're still getting the same reading. We really dropped down with the 5 day of the equity put call ratio. Of course, we went back up a little bit here, which could be considered negative. And this is coming off of a really, really low reading right now, but we're still going down with the 10 day equity put call ratio. So we're getting a mixed picture there. No real change in volatility risk premium. Imagine that. We're down as much as we were, and there was actually a decline in fear looking out. And this is what folks, when this is high, that means things are risky and you should be compensated for owning stocks as compared to something that has no risk, like a US government bond. When this is going down, that just means there's no real advantage to owning stocks. The risk premium is dropping. Okay, but look at the advanced decline line. We came down a little bit based on volume, but we actually advanced based on price and saw some new highs being generated and really no new lows. We're still going up with the 5 day and 10 day. So the internals are still showing strength. We actually went up with the advanced decline ratio, both in the short and intermediate term. And we actually came down a little bit, but we're still above zero with the advanced decline ratio based on volume. And look at this, the 10-day simple moving average of the advanced minus decliners. We're like pegging at the top here. Now, this could be concerning because we had really high readings like this before. It may mean we go sideways. It may mean that we're getting near a top of some kind here. But to have the down day like we saw and this to go up is not what you would expect to see. Our smart money indicators. Now, I don't know what's going on with the boom indicator. We clearly went up with accumulation distribution above the moving average, but the boom indicator is going down. That's strange. This got stronger. And we actually improved with the chicken money flow. And we're continuing to go up with the chicken oscillator. So there was some smart money coming in and doing some buying. And that was picked up by our three smart money indicators. We're still positive here, even though we are coming down with the green line and up at the red line when we look at the vortex. And no real damage done here with the cumulative advanced decline line for the S&P. Actually went up based on price and came down just a little bit based on volume. Still improving with our 10-day average of the S&P 500 highs minus the lows above 50 and going up. Seeing more of a connection now where we had been getting a disconnect between the S&P, the bar chart, and the red line, which is the NYSE advanced decline line. They're more in line with each other. They're coming back together. And looking at the NYSE cumulative advanced decline line, just hanging in there really well, still above the moving average with this NYSE advanced decline line and the other NYSE advanced decline line. Break it out based on common stock, going up based on price, going up based on volume. Advanced decline line studies, still above the moving average with all indexes, and we actually turned up with these indicators on Monday. Still above zero with our broad market measure, the 5-period moving average of the highs minus the lows. Even went up with the stocks inside the S&P above their 20-period moving averages. We're getting back above 80 now, so this is a bit of a concern, even though we could still go up more from here. And we're above 70, that's when it's showing good momentum. When we get concerned is when we get up above 80, which is what we're seeing right now. We went up with the 50-day moving average study, the 100-period moving average study, and the 200-period moving average study. Not what you would expect to see if the stock market's getting ready to fall apart. Now, the perma bears, the one or two that I follow, they're patting themselves on the back at what geniuses they are, but they don't look at stuff like this. They're just going on, well, we just can't continue to go up. And I draw my little Elliott wave lines all around, and it always has a down arrow at the end when it comes to stocks, and it always has an up arrow when it comes to gold. And that's what they've been saying for 20 years. And if they looked at stuff like this, they may come to different conclusions, but they want to be negative all the time. So it's like you can't argue with them with facts. All right. So not much of a change here overall with our daily chart, although we did really pick up with volume. We actually went up with the 20, 50, and 200 period moving averages on the S&P. Figure that one out. And we're no longer extreme with the boom indicator based on 20 periods. We had become kind of far away from that moving average. We pulled back, which is kind of makes sense there. And we're coming down after being extreme with the Stochk RSI, the Williams percent R, the CCI 14 and 20. So that kind of caught the market off guard with this move on Monday, enough to kind of jitter our short-term indicators. Coming down in the short-term stochastic, rolling over now in the intermediate short term, but still going up with our longer-term stochastic and getting extreme there. The force index did drop below zero. This is a pretty touchy indicator too. And being that we were down as much as we were, it's not surprising that this turned negative. We did drop below the green line and the blue line here with a short-term trend. So that shows a little bit of vulnerability in the short term. But we're using the 20-period simple and exponential moving averages, especially the simple, that's the red line. That was support in Monday's session. We bounced up off of that. And even though we fell down below the midpoint here with our standard deviations chart, we closed back above the midpoint. And not much of a change here with the balance of power, just a little tick down and still positive. We're no longer extreme with the CMB composite, and we're still positive. This will probably redraw here. The go no go had switched to positive with the blue bars. It's probably not going to stay that way. And we're still above the midpoint here with our highest high chart. The TTM squeeze is continuing to go up. Still showing a lot of speed right now as far as standard deviation, meaning that the S&P has been moving pretty fast, either up or down. We did drop negative with the ease of movement. We dropped slightly below zero again after we just recently turned positive. The Erin indicator didn't notice anything happening. And the S&P McClellan oscillator actually ticked up and we're above 60. So we're still extreme here. But to see the kind of day we saw and to have this go up is quite surprising. We're still going up with the summation index based on price and volume. We declined a little bit with the NYSE McClellan oscillator, but we're still above zero. So we're still going up with the summation index based on price and volume for the NYSE. This was a warning sign that we saw after Friday, and this was about the only warning sign we saw. And it's continuing to decline. The Swenlin trading oscillator based on price and volume. Is this telling us something? Is there more damage to come? This is about the only chart suggesting that. Plus, we have some extreme positive readings that we're a little bit concerned about right now. Momentum is still positive with the PMO. We're also going up based on price and volume. We're coming down, just not quite extreme now with the PMOs that are rising, but the buy signals are going up, and now they're extreme positive, and the PMOs that are above zero continue to advance. We've gone to have a down day like we saw, and we've gone from positive to neutral. We haven't even switched over to negative for the S&P, and this is a pretty healthy looking bar, even though we gapped down. We opened at the low and closed pretty much at the high. So that shows some intraday strength coming back into the market. We're still positive with the parabolic SAR. And if you watch the weekly video at the end of last week, the weekly chart for the parabolic SAR is now positive. Momentum in the short term is still positive and just starting to get close to being extreme with the slope oscillator. The MACD is still going up. All of our different oscillators in the short, intermediate, long term, they're still going up. The copy curve is still going up. The Sean trend meter did fall off though. It got up into this darker, sickly looking green area and then really dropped down more to neutral. This would be treated more as negative because we're going down with this indicator. We declined, but still above 50 with the money flow as well as the ultimate oscillator. Decline, but still above the moving average with on-balance volume. We're still working off of a Pring bottom fissure buy signal. And we're waiting to see, are we going to come down below the red dashed line here with the mass index? And that would suggest a change in whatever's happening. The RSI did decline, but we're still above 50 with the 14 period and the 9 period. And saw some vulnerability here with our intermediate term trend. We came down below the red line. We can get back above this. That would keep these lines going up. And this was another area. We had the 50 period simple moving average. We came down a little bit below that, at least at the open. It was really the short term moving averages, the 20s, that provided the most support. And so we're back above all the plotted moving averages here. You wouldn't know that, I mean, with the huge gap down, but we ended up closing back above all these lines. And the bullish percent index actually advanced. That's still positive. We're still going up with the NYSE bullish percent index. We did decline here because a lot of the semiconductors and big stocks are in the NASDAQ 100, but we're still above 50 with the NASDAQ 100 BPI. And we came down right here to the midpoint of this little mini rainbow with our 20 period simple moving average of the open, high, low, close. And then we were able to bounce back above the rainbow again. So for right now, these charts are holding up. We're still improving with the Ichimoku cloud. We're above, well, no, I shouldn't say that. We're back into the cloud here, but the blue line is still trying to go above the red line, even though the green line came down. This is something I've been trying to point out because it could be longer term negative. We're hitting resistance here with this trend channel. Now, right after this, I have another chart. That's same thing, but they draw it different. I go from the low that we hit back in 2008, and then I put the midpoint in the middle. I don't know where they get this from. I'm not sure where the logic comes from that, but they have us at the midpoint of this trend channel here. No matter how you draw this and wherever you come up with these parallel lines, we're hitting resistance, whether it's the midpoint or the upper end of the trend channel. We are negative now with the Heiken Ashi with the black candle. We're still positive, but pointing down with the Kegi chart. Renko chart's like, what? Something happened? It's positive. We're still positive with the three-line break chart. And we actually went up with our 150 and 200 period moving averages. All right. And we switched to negative in the short term with the NASDAQ 100. All the different indexes are still positive on all the different time frames. We're switching back to positive with bonds. That drop that we saw, that meant price was going up as interest rates were going down. We switched to negative with short term and commodities and with the dollar. And you can see here, tech, that ended up being down the most. Utilities got hit because where are they going to get all this electricity from? Industrials and then energy, where all the other sectors ended up being positive with staples, a defensive area, healthcare, a defensive area. Those are the ones that perform the best. We still are seeing financials going up. Real estate may have gotten a bounce from interest rates coming down. Discretionary was still up. Communication, another growth area, it was up, and materials were virtually unchanged but slightly positive. Awful lot of red here. Awful lot of NASDAQ and S&P dropping below 6,000, 19.9, 19.8, 19.7, 654. Three blast off here. The communication sector had a BPI cross above 70. The euro, after going above 105, now is below 105 since we saw some strength in the dollar. We had another BPI cross below 50 with the NASDAQ. Real estate crossed above 50. So, yeah, most of the red that we see here was just the NASDAQ dropping hundreds of points at a time. And seeing a little bit of an improvement here because the equal weight ended up doing quite well compared to the weighted version here. So they're coming a little bit closer to each other. And we're really going down here. This just means the weighted version underperformed the equal weight version of the S&P 500. And the Dow was up. We got above this pivot point here, above the 50-day moving average. Not back to an all-time high yet, but not all that far away either. We're still positive with the diamonds when looking at the Elder's Impulse system. The NASDAQ is what got hit. It was down over 3%. And it's hard to see because of this big P right here, but we're below the 50-day moving average. We're down almost 3% with the NASDAQ 100, also below the 50-day moving average. That needs to be recaptured to have things turn back more positive. We've gone from positive to negative with the Qs when looking at the Elder's Impulse system. The momentum is still positive for the NASDAQ 100, but we're rolling over. We did get down below the 20 and 50 period moving averages. So some support levels were lost in Monday's session. We'll see if we're able to get those back or if this is the beginning of some more weakness that's beginning to develop. But we're just not seeing it in other areas right now. Small caps still under their 50-day moving average, also under the 50-day moving average with the Russell 2000 small caps, and still neutral with the small caps with the Elder's Impulse system, right at the 50-day moving average with the mid caps, neutral with the mid caps with the Elder's Impulse system here. We were up over 1% with the financial sector. And the bank ETF was able to get above its 50-day moving average. But it did so last week. Can we stay above this now and keep going up? That would help the overall market be more positive. The Wilshire came down, fell below its 50-day moving average, but was able to close up off of that. And same thing here with the total US stock ETF. We're still above the 50-day moving average. And we saw a big spike up here with the staples to tech ratio. Since staples did well and tech got hammered, that's why we're seeing this ratio going up. But in the bigger picture, this ratio continues to decline. The FANG index came down 3.67%, but still above its 50-day moving average. And we came right down to this longer term trend line. Is that going to provide some kind of support? And this is the big craze here. And I showed this over the weekend, and I've been focused a little bit more on this, mainly from the positive side of things. This is the robotics and AI ETF because we were really starting to break out above the rainbow. No, we did an about face there. And we're actually this could actually be more positive because we're starting to break above the 250-day moving average when we look at the ratio of the AI ETF with the tech sector. Apple was up over 3%. Yeah, pretty negative day, don't you think? Amazon was up a quarter of a percent. Google was down 4%. It's one of those AI companies. Microsoft was down over 2%. Meta was up almost 2%, setting an all-time high. Nvidia, this was the big story stock. Okay, story stock. Yeah. Dropping below its 200-day moving average. Is this the beginning of something, or will we bounce back quickly? Tesla was down 2.32%, coming down to its 50-day moving average. Netflix down 0.58%, still coming off of an all-time high. Still showing a pretty solid correlation between US stocks and world stocks in the short term and in the long term. Then this is what we're watching now. This is why I've been watching lots of different semiconductor charts. This had been positive. Now we're dropping below the 200-day moving average. And I pointed this out over the weekend. See how we were able to clear these previous highs? Can we hold on to that? No. And we're coming back down to the 250-day moving average. Is this the beginning of something, or will we bounce up from this? And this had already been negative. The stocks index, well, it's down 7.84% here, below both of the moving averages right now. And we really declined with the semi to tech ratio. And this also declined when we do a ratio between semis and the Dow. Oil is also dropping. It was down 2%, getting into the low 70s. And coming down and dealing with the 50-day moving average here with the dollar. We actually bounced back up on Monday there. Coming down with interest rates. It would be really helpful to the market if we could continue to drop below the 4.5 level and we were up with the 10-year based on price. And can we continue to decline here with interest rates? That would really help things. But they've been pretty choppy lately. Looks like something starts to happen and then we kind of switch and go the other way. This showed a bit of an improvement. The home construction ETF, the 3 to 7 year bonds, but we're still underneath the 250 period moving average. We're watching the red line here. These are Japanese interest rates. If they really start to go up, that could cause what we saw last summer as far as a freak out. And did take a hit with our growth to value ratios. We're dropping with the Qs to S&P. We actually went up with discretionary to the S&P, and we're dropping when we compare large cap growth to large cap value. So we're below the moving average and declining with the large caps. Mid caps drop below the moving average, as did the small caps. And we saw a big spike up here, but longer term, we're still going down when we look at the staples to S&P 500 ratio. So what's our outlook? We're dealing with earnings season. We're going to get Apple, Microsoft, Meta, Amazon.com, Tesla. Yeah, pretty big companies coming out. And this is kind of an interesting way to approach this. This isn't 40% of S&P 500 companies. This is 40% of the market cap of the S&P 500 is going to report earnings this week. So that's more, can have more of an impact. We're going to have the FOMC meeting on Wednesday. And we are positive, but there is rotation that's occurring. We're going away from growth into value, getting more defensive. Is this more short term, or are we going to see a gradual shift, maybe not even so gradual, over to a more defensive posture for the market? We're going to get durable goods, the FHFA housing price index, Case-Shiller home price index, consumer confidence in Tuesday's session, and then all the geopolitical stuff. And now that DeepSeek is part of everybody's vocabulary, that'll probably be one of the things that folks are worried about. All right, then on Wednesdays when the Fed meets, we're going to get jobless claims and GDP on Thursday, and the core PCE is going to come out on Friday with the employment cost index. Here's a highlight of what things are looking like for Tuesday from the economic report side of things. Seasonality neutral to positive with the Dow and S&P, where we're flat out positive with the Nasdaq. It'd be kind of nice for positive seasonality to kick in. And we do see some positive seasonality now with the green dashed line. It continues to go up, and we a little bit of weakness going into the last day of January, but typically this is positive. This takes all the different ways of jumbling things together and then saying, okay, the black line, these are all post-election years together. The fifth year of a presidency, that's the pink line here. And that's really what Trump is, because even though they weren't consecutive terms, and then the green line was is just where the incumbent party wins. Well, that's not what happened. The red line is when the incumbent party loses. That usually means there was bad things going on. And then the other blue line here is just taking all of it together. And we're in the second half of January, which tends to perform well. Small caps really not breaking out right now. These are continuing to be a bit of a disappointment there. We are in positive seasonality according to Tom Bowley's research from now throughout the rest of this week, which will be the end of January. So, oops, in the wrong order there. We're going up with the equity put call ratio based on 5 periods and the ease of movement. Still not a very long list here. And, and to me, this is a warning sign by itself. When everything is positive and you might have one or two little things negative, it's like, what's left to be positive now? Oh, and then we have the Swenlin trading oscillator, and that could be giving us some kind of an early warning sign. But when you look at the positive side, our smart money indicators, they improved. The growth of value took a hit. Discretion into staples took a hit. They are weaker, but we'll have to see if we're seeing more than just a short-term change happening there. And we're going down with the 10-day equity put call ratio. The advanced decline line actually improved. We're still extreme with the S&P McClellan oscillator. We're still positive with the NYSE McClellan oscillator. When those are positive, the summation indexes are positive. Momentum is still positive. The parabolic SAR, the bullish percent indexes for the S&P actually went up. The vortex is positive, although it took a bit of a hit. Our moving average studies improved. The money flow is positive. The ultimate oscillator, financial sector is positive. And we are still positive with the NASDAQ 100 momentum, but we are declining. So our conclusion, we're positive. Right now, it just looks like a pullback. You sure wouldn't know that. You'd think it was the end of the world based on what was happening and the reaction to it. As we're seeing more of a rotation to safety. Now, based on the earnings reports that come out and the economic reports, that rotation that we saw on Monday, is that going to rotate back over to growth and turn things back more positive? That's what we'll be waiting to see. We're still positive, but pulling back right now in the short term. We're still positive in the intermediate term and still showing a few overbought conditions. And we're still positive in the long term. Thank you. I hope you have a great day, and I will talk to you in the next video.